I mean, your latest long-term work kind of maps a potential peak in gold around $13,000, but between 2029 and 2031. Now, some investors will hear that and celebrate. Others will immediately roll their eyes, as you know. But build that bridge for us. I mean, how does gold get from around $4,000 to 13,000?
Yeah, so it's based on a calculator that I created, and essentially the calculator takes into effect multiple factors. One is how fast is the money supply, and again, we're not talking U.S. money supply, global money supply running, and right now it's running at 7%. So if you just assume over the next 5 years at 7.5% or greater, that starts to push the cycle of gold. And what we looked at here is when you have the first cycle between 1980, the second peak was 2011. So we're talking, I mean, 31 years there of interim cycle. And then the next cycle, it was just 2011 to this 2026 high. And so what we're seeing is because of the increased US deficit and global debt, the increased money supply, real rates, and inflation, all of these are creating shorter cycles in gold and then more dramatic moves to the upside. And essentially, it's a calculator that calculates the probabilities of the next move. And again, it's telling me that 13,000 is going to be the next peak, but again, between 2029 and 2031.
Gold just staged a stunning $100 intraday reversal after the Federal Reserve's latest decision. But according to Gareth Soloway, today's rally may be only a small piece of a much bigger story. He believes rising debt, persistent inflation, and weakening confidence in paper currencies could eventually push gold toward levels few investors think are possible. At the same time, he warns that the AI boom may be entering a dangerous phase. Here's why.
Let's begin with gold. I mean, it traded down to roughly $39.95 this morning, and it has now broken above that $4,100 in the same session. I mean, sitting here kind of floating on that level. So, I mean, does that $100 reversal kind of confirm that the buyers have taken control, or does gold need to kind of close above 4,100 before this becomes a genuine technical breakout?
Yeah, and that's really what the charts are telling us. So, I mean, great move on gold, but look at how this what we call a wedge pattern in technical analysis has behaved. You take your all-time high, it hits again here and here all the way down. And recently, we've been hugging just below this major trend line. And this trend line for me is essentially the line that I'm watching to know when there's a breakout in gold. And notice how today we rallied up into that line, and so far gold has pulled back off of it. And so as a technician, simply put, just like you said, 4,100, we need to clear that hurdle on a daily closing basis. If that happens, you have a short-term breakout. I don't, by the way, think gold's going to zoom right to 5,600 again. It's going to take some time. It's going to take some digestion, but that's the first step in potentially seeing gold start to recover and move back to its all-time highs.
Yeah, so I mean, a little close, maybe above 4,100 tells you that this, was more than just a temporary reaction to this.
That's what I think. I think, again, we have to respect the trend line that has held up since the highs on gold until price really clears that hurdle and holds above it. I'm looking at it a little skeptical. Now, you guys know that overall I've been bearish on gold, but I'm now at a point, and once we got below 4,000, where there's a little bit of downside potential, but we're close to the end of this down cycle before I do think the price on gold starts to move up. And it's got some upside potential over the next few years.
Yeah, yeah. I mean, I was watching. I know you put out some new targets too. We'll get to those. I mean, the first move following a Federal Reserve's decision is not always the move that lasts. I mean, what follow through do you kind of need tomorrow and then into the end of the next week before you believe this rally has real buyers behind it?
Yeah, and so the first thing we want to see is that close above 4,100. Once we get that, you don't want to see the next day it come right back below 4,100. So there's something called the confirmation signal, where you get a close above a key level, and then you need to see a secondary close above that level and a little bit higher than the previous day's high. What that tells me is there's real teeth to the move. It wasn't just a whipsaw like you're talking about here, where we're seeing this kind of move up on the back of Kevin Warsh's statement and the Federal Reserve statement, where we can see these type of whippiness, but where do things settle? Where does the dust settle? And that gives us the signal there. And really the other thing too is the dollar's been hovering here. And if we go to the charts, let me show you guys this. This is interesting. So the dollar has been hovering right up in this upper zone. And we could see again, going back a ways, even back over here in 2025, we came up to this high and it got rejected. And here we are, we came up, rejected, and here we are again getting rejected. You want to see the dollar continue to fall here. If the dollar continues to back off resistance, now we're in a state of potential upside in gold. Lastly, just watch this trend line here. If we pull back to just under 100 on the DXY, and if we break that, gold's got significant upside in the near term and midterm.
Yeah, I was going to say, I mean, if Wars keeps a September rate hike kind of alive and the dollar holds this range, I mean, can gold kind of continue rising with that sustained dollar strength that you've seen?
You know, it's going to be tough for gold, right?
Yeah.
And part of it, too, is that oil is a major component here. Oil is pushing up the 10-year yield because it's raising inflation expectations. And so we've seen recently this run up on oil back into the $80+ range. You want to see oil come in. That will relax the potential of these rate hikes. We also want to see what the jobs data is coming up for this past month here as we're coming to the end of the month. And we want to look to see, is the jobs market as strong as people think it is? And if it starts to weaken a little bit, the dollar will fall very quickly, and that's one more positive for the gold price.
Hey, quickly on this, I mean, I want to move on to your gold call, but I'm curious, I mean, could today's move have been kind of accelerated by traders who were positioned maybe for a surprise increase and suddenly had to cover?
I do think so. I think that the sentiment on gold has gotten to almost equal bearishness versus how bullish it was when we were trading north of 5,000. I mean, I used to do videos and people would attack me for saying gold was going to pull back. And now vice versa, I'm seeing when I do a video on gold and I talk about the cycle here and the bigger cycle that we're in, how we're going to eventually break out and make new all-time highs, people are telling me gold's going back to 1,800. And so it's the inverse of what we saw at the highs, which actually then creates that bullish catalyst for the offsides trade to kind of push gold back higher.
Gold's dramatic reversal grabbed everyone's attention. But Soloway says the real story isn't today's rally. It's investor psychology. He argues that sentiment has flipped from extreme optimism at the highs to widespread pessimism after the recent decline. Historically, those emotional extremes often appear near important turning points. Even so, he stresses that gold still needs to confirm the move by breaking key technical resistance before calling it the start of a new bull trend.
Your latest video, and it's kind of, we need to talk about that number that jumps off the page. I mean, your latest long-term work kind of maps a potential peak in gold around $13,000, but between 2029 and 2031. Now, some investors will hear that and celebrate. Others will immediately roll their eyes, as you know. But build that bridge for us. I mean, how does gold get from around $4,000 to $13,000?
Yeah, so it's based on a calculator that I created, and essentially the calculator takes into effect multiple factors. One is how fast is the money supply, and again, we're not talking U.S. money supply, global money supply running, and right now it's running at 7%. So if you just assume over the next 5 years at 7.5% or greater, that starts to push the cycle of gold. And what we looked at here is when you have the first cycle between 1980, the second peak was 2011. So we're talking, I mean, 31 years there of interim cycle. And then the next cycle, it was just 2011 to this 2026 high. And so what we're seeing is because of the increased U.S. deficit and global debt, the increased money supply, real rates, and inflation, all of these are creating shorter cycles in gold and then more dramatic moves to the upside. And essentially, it's a calculator that calculates the probabilities of the next move. And again, it's telling me that 13,000 is going to be the next peak, but again, between 2029 and 2031. Now, like you said, people are going to hear that and say, oh, I don't want to wait that long. But keep in mind, that doesn't mean we're not going to make new all-time highs before that. It just means the next cycle peak, the one that, we dream about, that may just take a few years to come by. And it's really at shortest about 3 years out.
Okay. So, I mean, you got that calculator you're talking about. What's doing most of the work in the model? I mean, is it kind of that technical cycle that you were just chatting about? Is it government debt, central bank buying, falling confidence in government bonds, or does gold need all of those forces moving together, you think?
The calculator accounts for all of those cycles, right? Or all of those factors, and it gives different weightings to the importance of it. Part of this cycle calculator as well is analyzing the fiat feeling. And then what I mean by that is, how do people look at fiat? And if you looked at in 1980, we had incredible inflation, But at the same time, we saw Volcker come out and he really reestablished that we're going to clamp down on this. And over the course of that next 20, 30, 40 years, we've seen the fiat feeling. In other words, how do people feel about the dollar and other currencies? And we know they're printing them and the governments are running up debt. It's starting to slide. And so these factors all go into the model, and it really just projects out based on the past cycles and how quickly it's coming. When will the next cycle be, and what is the likely peak, taking into account these other variables?
You know, I wonder, Gareth, I mean, if gold reaches $13,000, has gold become dramatically more valuable here, or has the dollar simply become worth dramatically less?
Yeah, and I think it's more about the structural need for people to have security, and it's the fact that the dollar needs to be measured. And this is interesting, right? If you look at the dollar, the DXY, we're basically at levels we were years ago. And so if you look at the dollar by itself, you say, well, the dollar really hasn't lost any value. That's not true. And the reason it's not true is because you're pricing it against all the other currencies, the 5 other currencies, and they're all printing too. And so really it's a matter of saying, okay, well, yes, the dollar is still holding its strength, but that's relative to these other currencies that have been printed ad nauseum with the dollar. You have to look at it on a universal basis against the growth in supply. I believe gold is growing about 1.7% per year in supply versus the printing of money, the debt increase, all of these other factors. And that's one of the reasons why this model shows that there is such significant upside in gold, because there's no chance, in my opinion, there's no chance we can go back to Volcker, right? Yeah. I mean, could you imagine with the U.S. debt where it is, if interest rates even went up to 10%? And so when you have that in effect, it means that Volcker can't come back, which means you're not going to get a downside move like we saw in the 1980s in gold. And in other words, it's going to drive gold higher quite substantially.
This is the core of Soloway's long-term thesis. His argument isn't simply that gold becomes more valuable. It is that expanding debt, continued money creation, and structurally lower real interest rates gradually reduce the purchasing power of fiat currencies, potentially supporting much higher gold prices over time.
What would kind of make you reconsider the $13,000 target? Give me, the price or kind of a development that would tell you that the model's no longer behaving as you expected.
Yeah, and so for instance, if we saw, let's say, AI create deflation, right. If we saw the productivity going up substantially, but again, that deflation being created by AI, that would be something that we'd have to take into account. And what's interesting is with the model, it actually gives us a significant ability here to kind of project that out. And I want to, if you don't mind, I want to try sharing this with you guys. If we get to this, and here's the gold calculator, what we can see here is that we have our different inputs. You have debt issuance pace, and this is right here our current conditions. So right now, every year the U.S. is printing basically $2 trillion. All right, and the idea is that that's probably going to go up based on the kind of the cycle that we've seen with it increasing over time. Then we have global money supply rising at 7% a year. We have the fiat mistrust index, which continues to inch up little by little. And then we have real interest rates. And so the idea is that what I did is I said, okay, this is my base case. And if we flip to the base case, it shows that on average over the next 5 years, we're likely going to be printing or adding additional debt per year of 2.8 trillion. And that's the average over the next 5 years. Global money supply is going to likely increase to 9%. The fiat mistrust analysis is going to accelerate, and then real interest rates is going to be drifting to zero. In other words, the Fed is likely going to eventually cut rates, but inflation is not going to go down substantially. And so when you calculate that all out, it gives us a target range right here with a $13,000 peak. And again, what's beautiful about this is you just brought up, like, what if real interest rates are positive? Well, now all of a sudden, this changes the calculation to $6,000. And so people can really, and again, I can give you guys the link so people can actually just play around with this. You can put in your own numbers. Like maybe you think the debt issuance pace will jump massively to 4.7 trillion. In any case, the point is the calculations tell me, based on my best assessment of the data and probability, that we're looking at that next peak around 13,000.
One reason this section adds credibility is that Soloway explains what could invalidate his own forecast. He points to scenarios like AI-driven deflation or stronger real interest rates that would materially change the outlook.
Silver rarely does anything quietly, as you know. Today was no exception. It moved roughly $56 and 64 cents to more than 59. I think it's back around 58. Anyway, that's a gain of more than 3%. So, I mean, does silver's stronger move confirm what gold is doing, or is silver simply exaggerating that short-term action as it often does?
Yeah, I think for the most part, it's exaggerating it just because silver tends to move in multiples of gold, or at least 2x gold. I am not loving this chart yet on silver. I still think there's downside. You can see again, you had this beautiful base right here where we just kept on hammering on it as support, and then finally we broke lower. And then notice how this trend line was support, but once you break down, it becomes resistance. And we went up into it and price got rejected. And now we're just kind of floating sideways. There's no real good nature to this. So on silver, I need to see us recapture this $65 to $64 level and break out above this trend line, much like I need to see gold break out before I can get heavily bullish on this. And I actually still think there's a good chance we touch $50 and retrace to the 2011 peak before silver really has its next major run.
That's interesting. Okay, so it'll test that zone, and they could expect that test and maybe a nice little bounce after that.
Yeah, that's what I'm thinking right now. And so I wouldn't be surprised if silver still has more downside. Now, you might say, well, if can gold break out without silver? And the answer is it can. It's generally unlikely, but it could break out slightly. And the key why silver could be an underperformer is imagine all of a sudden we get a slowdown in CapEx for data centers. We know that a lot of silver and copper is being used there. Or if the global or domestic economy slows down, that industrial side of silver could mean that silver does underperform in the near term if we get that economic slowdown.
Many investors expect silver to outperform immediately, but Soloway argues that gold currently offers a stronger risk-adjusted opportunity, while silver could remain more volatile.
When a company delivers enormous profit growth, promises even more AI spending, and investors kind of sell the stock anyway, I mean, what is the market questioning here?
The market's questioning that, is this money well spent, right? I mean, every time we see, for instance, Alphabet had amazing earnings, but they said, hey, we're going to raise CapEx, and the stock sold off. And it's a matter of, okay, if you're going to spend $200 billion a year, what type of return will you get, and how long will that take to come around? And that's where we start to get into these scenarios that these stocks had all run up precipitously, thinking that there'll never be a slowdown. And that's just not the way cycles work. It doesn't matter what it is. If it's AI or the internet bubble of 2000, there are going to be slowdowns. And when you're investing that much money, again, investors just aren't believing right now that there's going to be a significant return. And again, the Kospi is a great example of this. If we look at this chart, number one, I'm actually bullish on the Kospi now. It's finally corrected enough where I actually think it's going to find some major technical support. I mean, look at this area right in here. I think it's down about 40% in recent trading. Monster drop to the downside. But keep in mind, the Kospi is two stocks, make up over 50% of it. And this drives me nuts. And I don't mean to kind of go off on tangents in this interview, but you had a lot of officials over there in Asia saying, oh my goodness, we need to meet. This is horrible. It's dropping. And they introduced all these 3X ETFs. So when someone buys a 3X ETF, one share, the underlying ETF has to buy 3 shares of, Samsung or SK Hynix. And the problem with that is it's great on the way up and accelerates the move. But when people sell that, then it's 3X shares on the way down. And so you can't have it both ways. And these officials, if they're going to put in these type of things, it's great for that upside move, but it's also going to crash the market. And that's what we've seen here. We've seen a massive unwind. I mean, think about this. SanDisk here in the US broke $1,000 today before putting in a bottom, down from $2,350. And again, just a reminder, a general announcement. When you see everyone screaming buy, it's usually time to sell. And this was another example in the AI memory space where that is exactly what happened.
Yeah, it's interesting there on the 3 times leveraged ETFs. I mean, if the damage was kind of created by market structure rather than fundamentals, then your point is that strengthens the case for a sharp recovery once this forced selling is ending.
That's I think what's going to happen. And
Right.
let's be clear. I think the tops are in a lot of markets, including the semiconductors, because I do think margins are going to compress. There's no doubt about it. I mean, you have all these companies out of China that are now starting to get more notoriety for producing memory, and also what ASML does in terms of their technology. But when you have margins at 80 or 90%, every other company out there is looking and saying, wow, that's amazing. How do we get a piece of that? And that creates more supply eventually, and that will lower margins. And so, again, you're going to get a snapback that's probably epic in these stocks. I mean, I could see SanDisk going back to 13 to 1500, 50% upside potentially off the lows. But at the same time, you got to just be realistic that these are cyclical. People tell you it's different this time. They said the same thing in the internet bubble before it collapsed. And sure, some of those companies emerged, like Cisco, great business model, but it still doesn't mean that they're not going to have crashes out of them. And I do think, again, bounces are to be sold into in the semis.
The conversation now shifts from precious metals to technology. Soloway compares today's AI enthusiasm to previous market cycles, arguing that transformative technologies can still experience significant valuation corrections.
The New York Fed says dysfunction in investment-grade corporate bonds is at its highest level in nearly 3 years, just as AI companies are issuing this record amount of debt that we're talking about. I mean, is credit now kind of confirming the warning in tech stocks too, you think?
I think so. I think those credit spreads are really starting to raise alarm bells. And this is where, as an investor, you have to start saying, okay, Kevin Warsh was talking a solid game here. But if there starts to be a credit crisis, is the Fed really going to say, hey, inflation's still at 3.5%, we're not going to lower rates? Or are they going to come to the rescue and start printing money again? And this is really something that is, as I'm seeing the market react here in real time, is getting my attention that something bigger could be in the works here.
Rather than focusing only on stock prices, Soloway points to stress in credit markets. Historically, credit conditions often deteriorate before broader financial weakness becomes obvious.
Bring all of this kind of back home for the person watching today's volatility, wondering what to do next. I mean, gold sitting around that 4,100. Technology seems to be weakening a bit. Oil surging. Credit showing up in some strain again. I mean, what should they own? What should they avoid? What do you think is kind of a single level that they should watch tomorrow?
So for me, it's going to be seeing where the markets close and then seeing, do we see continuation on the S&P 500? I really am a true believer that we are right on this level right now on the chart. Do we close below this 73.30 level or not? If we do, there could be some significant downside over the next couple of weeks on the S&P to this 7,000 marker. So I'm going to be watching this like a hawk. If it closes above, I'm going to be neutral to bullish going into tomorrow. I also want to see where the Kospi trades tonight. I think that is a key indicator of the U.S. markets, even though you think, well, what does South Korea have an impact on the U.S. markets? Well, because it's two major semiconductor stocks, it absolutely does. And then also watch Meta and Microsoft after the bell. That is going to be huge. What do they announce on CapEx spending? Are they raising totally? Are they going to say something that's going to scare the markets? These are all, this market is so fluid, Jeremy. You got to stay on point.
Yeah, no kidding. So you're not adding any risk here, obviously, Gareth. I mean, you're not reducing it, but I guess you're holding some cash too.
I am holding some cash, and I have deployed some cash into some semiconductors that have dropped, like, for instance, SanDisk. Yeah. I've inched in a tiny position here. If we look at the chart on SanDisk here, there's a major trend line. Look at this trend line going back all the way to essentially the beginning of the bull market on SanDisk in 2025 in December, connecting perfectly through this low pivot. And look at what we hit today. Again, we're seeing some selling back off in SanDisk into the end of the day, but this is a trend line that after this, what is this? Let's see, is this a 50%? I think it might even be a 55%. Yeah, 57% decline in essentially a month. The story's not going away there. And again, as bearish as I was when it was north of 2,000, now I'm starting to say, all right, this is due for a bounce. This is at a technical level. The story of memory demand, again, is not evaporating. These new hubs of production are not coming online tomorrow by any stretch. And so I think there's at least a technical swing trade bounce here. I wouldn't marry this thing. I still think it's going to eventually go lower, but I do think there's some opportunities to deploy cash here.
Instead of ending with fear, Soloway outlines what he is actually watching: key S&P levels, semiconductor earnings, and disciplined cash deployment. The takeaway is to stay focused on evidence rather than emotion. Today's volatility may eventually be forgotten, but the larger questions remain. Can governments control rising debt without creating more inflation? Has the AI boom become too optimistic? And is gold entering the next stage of a long-term cycle? Gareth Soloway believes those answers will shape markets for years to come. Whether his forecast proves correct or not, the coming years could look very different from the last decade.